Welcome back. Alphabet and Amazon reporting stellar earnings after the bell last night. Alphabet's net profit was up almost 30%. Amazon's profit was up over 40%. Joining us is UBS Internet and media analyst Eric Sheridan. Now, Eric, wait a second. No, revenue up at Amazon, correct? I mean, really, revenue has been the story at Amazon, not profitability.
They did also beat on profitability last night.
Yeah.
They came in around 25% better than the street on earnings.
Wow.
They did guide a little bit lower on earnings for next quarter in terms of profitability, but right now when you're seeing these signs of growth, investors are giving them a pass on the investment cycle because the investments are paying off with faster and faster growth every quarter.
So you have a buy rating on both these stocks. Does that mean even after this huge run-up that we've seen, you'd put new money to work right now in Amazon or Alphabet?
I would. You know, between the two, we have a little bit more of a positive risk reward for Alphabet over Amazon, just because the earnings multiple is cheaper. You're only paying around 20 times free cash flow for Alphabet now. So valuation, always a tough argument with Amazon, but you can't argue with the scale and the growth of the company.
So, Eric, the companies both put up massive quarters, and we talk about the $1 trillion number. Who's going to be the first to trillion? Will it be Apple? Will it be Alphabet? Will it be Amazon? Is there a chance that the government steps in here on any one of the mentioned companies and says, this company's getting too big, too powerful, let's break them up?
It's the § 1 risk factor that we have identified for investors. You know, when we put out our big top 10 themes every year, regulation's the § 1 risk, right? You know, these companies are growing fast. They are large in size. They are displacing a lot of other areas of the economy. Never know or can get an edge on regulation, but that's probably the biggest risk.
But do you think that's a risk with the Trump administration?
There are mixed signals on that. You know, most people view the Trump administration as a bit more of an old economy than a new economy approach as an administration. I think that is being debated amongst investors. And yet, here's two companies that are examples of American exceptionalism at its finest. You know, growing global powers, you know, gaining increasing strength. I don't have any great edge on which one of those wins out in the Trump administration.
Talk about Amazon Web Services. That's been a big driver for Amazon, but I think this last quarter we saw some signs that competition is heating up there. Maybe the growth is going to slow a little bit. How do you see Amazon playing out against some of its big rivals, Microsoft and others?
Yeah, well, it plays into both companies that reported. We really think cloud computing is a three-horse race. It's AWS from Amazon, it's Azure from Microsoft, and it's GCP, Google Compute Engine, from Google. That drove Google's results on other revenues. Their cloud computing business run by Diane Green. AWS continues to grow. It's a three-player market and really, frankly, probably about a $500 billion end market that's still very small penetration today.
Does IBM fit into that list?
You know, IBM is a bit more of a legacy player. I don't cover it, so I can't go too far down the road of opining about it. But I would say these newer entrants that are leading with public cloud are taking a lot of incremental share from existing IT players.
I mean, the quarter has been pretty good in terms of earnings, right, Mike? I mean, you're investing in this market all the time. How would you characterize things right now?
I think the quarter has been great, and I think really we talked about this going into the first quarter, that people were just feeling more positive, whether it was the potential for tax cuts or the potential for a pro-business administration. But I think that's what we're getting. And two of the biggest companies that could really benefit from that are both Alphabet and Amazon, because as the economy grows, their business just has so many different levers that they can pull to increase profitability, right?
They are both involved in many aspects of the economy. Obviously, advertising is the lead product at Google, but we're talking about cloud computing, we're talking about media consumption. Now with the Pixel and the Google Home, we're talking about hardware. Amazon clearly has a two-pronged story. E-commerce, how you shop, cloud computing, how enterprises do their IT services.
One of the reasons that we're talking so much about the growth numbers that we're seeing coming out of these technology names is that there's not a lot of growth. Look, we're right here on the doorstep of a GDP report that is expected to be horrible today, right? GDP is coming in about 2 hours, and we're expecting 0.5% growth for the quarter?
I think we're around a percent to 1.5%, but it's still it's a very bad number. And I agree, these are the companies that are driving growth. They're driving the creative destruction in the marketplace. They're moving into, as you know, every single industry, and they're reinventing it. When we talk about the government getting involved in shutting down a big company, that really scares me, because this is where the innovation and the growth is happening. If that happens, I'm not sure where the growth is going to come from.
Wouldn't be shut it down, though, to be clear.
Not to shut it down, but break it up, and still, you destroy that growth story that we're seeing here.
But Maria brings up a good point. I talk to institutional investors all day long in my position. There is a small smaller and smaller list of companies that are producing 20% plus top-line growth in a low GDP environment. So you're seeing a bit of survivorship bias in where people want to put incremental dollars to work.
Yeah, which is why the Trump administration's priority has been growth, moving the needle on economic growth and jobs. Eric, good to see you. Thanks so much.
you.
Eric Sheridan there.